In this video today, I'll be showing you why feeling financially behind at age 55 plus in 2026 isn't actually a numbers problem. It's a sequence awareness problem, and you may have more leverage than someone with twice your balance, but with worse timing. Through working with clients who have felt behind heading into retirement, I've discovered that readiness isn't about how much money you've saved. It's about how well you can control how that money enters the tax system over your retirement timeline. And if you're in your late 50s or early 60s with less than you'd hoped for, you're actually in a perfect window here where the tax system is still giving you options. That's exactly why I'm making this video today for you, to show you why the real catch-up move isn't saving more money, but flattening out your tax curve, how you can reduce your visibility to the IRS over time, and how you can sequence your withdrawals in low-friction years before the system stops asking you and starts taking from you. So let's get right into it. Many people assume that having $2 million or more in retirement accounts puts you in a distinct advantage for your future retirement. But ironically, we've seen that it often creates tax problems down the line and big ones. Required minimum distributions or RMDs can force out over $80,000 a year at age 73 in this situation. Whether you need the money or not, it doesn't matter. This can push you into higher tax bracket and higher Medicare cost. Contrast this with somebody who has $600,000 or $700,000 in retirement savings in pre-tax accounts. They might feel behind, but their lower income allows for more flexibility and access to tax planning strategies. So let me give you a real-world example here. Mark and Susan, they were both 58 when they came in to meet with us. They had about $680,000 in total saved, mostly in a traditional IRA and an old 401k. No pensions at all. They told me flat out, Adam, we feel really behind and undersaved for our future retirement. But here's the key. They were entering a 6-year window where their income would be unusually low, and that window turned out to be a massive advantage for their future retirement plan. That's what sequence awareness is all about. Understanding the value of low-income years, using them strategically, and recognizing that financial readiness is about control, not just accumulation. So feeling behind might actually mean that you're in a better position than you think. Let me now show you the very first tool that you have that high balance retirees often lose out on. It's modified adjusted gross income suppression and the Affordable Care Act advantage that gives you. So let me talk to you about this here. This MAGI suppression, it's about a lot more than just reducing your tax bill. It's about opening some doors, and some big ones at that. If you're under 65 and you can keep your modified adjusted gross income low, you can qualify for Affordable Care Act health insurance coverage subsidies that could be worth $15,000 or maybe even $25,000 per year. So for Mark and Susan, we intentionally kept their MAGI between 55 and 60 a year from 59 to 64. That qualified them for Affordable Care Act subsidies worth roughly $18,000 per year, while we simultaneously converted about $45,000 per year from their pre-tax IRA to their Roth. Most of that was in the 12% bracket. It's not a loophole here. It's a feature of the system that gives rewards strategically to low-income planning strategies, and it gives those who feel behind more options than those who are locked into high-income years and cannot pivot. So lower income gives you access to Affordable Care Act subsidies and really cheap Roth conversion options. But here's where it gets even more powerful for you. A strategic spend down is about deliberately reducing your IRA balance before the IRA forces withdrawals. So every dollar that you draw or convert now at a 12 or 22% bracket is a dollar that you won't be forced to take out later at potentially a higher rate of 24% or more. By age 73, Mark and Susan's projected RMD was originally estimated at just over $70,000 per year. After 8 years of planned spend downs and strategic Roth conversions, that number dropped to under $40,000, which kept them out of higher tax brackets and avoided Medicare IRMAA surcharges entirely. This not only lowered their future tax liability, but it also gave them peace of mind. And a core part of our Red Zone retirement planning process is maintaining at least 12 to 18 months worth of living expenses in cash. Why is that? Because if the market drops or an unexpected cost arises like medical bills or home repairs, you don't want to pull first from your IRA at a bad time. Cash gives you flexibility, control, and insulation from market volatility, helping you avoid spending it in down market or forcing you into a higher tax bracket because you have to take out from an IRA. So now that you see how spend downs can flatten out your future tax curve, if you want help building your dream retirement as a whole through our Red Zone retirement planning process, I want you to click the link in the description of this video, fill out the questionnaire, and I'll personally send you a video showing you exactly how to optimize your plan so you can apply all of this strategy to your own situation. Now let's talk about Social Security. Claiming Social Security at 62 often gets a bad rap, but it can be a smart move for many people if you do it strategically. It provides a stable income floor that you can build your tax strategy around, and it gives you clarity, knowing what you're actually working with today. So with that foundation, we've helped clients plan out precise IRA withdrawals and Roth conversions while minimizing these tax surprises. Also, it reduces your provisional income, which means less of your Social Security gets taxed and more of your Medicare premiums stay low for longer. So Social Security can be a tool if you plan around it the right way, not just a benefit for you. But there's one more move available if you're still working that you need to know about. So if you're still working or you're partially retired, this is the time to change where your money is going. Every pre-tax dollar now is another future RMD later that you have to take out. But what if you redirected it to a Roth IRA or an after-tax brokerage account? We helped one client do just that, shifting all contributions into a tax-free and flexible accounts. In 10 years, they had a far more balanced portfolio with more freedom in how they access fund, which allowed them to borrow strategically from different funds at different times depending on their needs, allowing them to play the tax game each and every year and keep their taxes lower versus if everything was all in a pre-tax account. And here's another key: eliminate debt before you retire. One of the biggest freedoms in retirement isn't just financial, it's psychological. No mortgage, no car payments, no second home debt. Living debt-free means you can control your cash flow now and reduce your monthly income needs dramatically because you don't have debt to pay off. I've seen clients enter retirement without debt, and the peace and confidence that they have knowing that, it's unmatched by far. The lack of obligation makes their money go further and their retirement feel richer. So now that you see how to turn off the RMD trap by saving in tax-free accounts like a Roth account or after-tax accounts like a brokerage account, because it allows you to be flexible in your withdrawals, I want to bring all of this together so that you can see the full picture. So again, if you're 55 plus and you're feeling behind, the good news is that you have options and time. And they're not just about contributing more, these options. Yes, take advantage of the catch-up contributions. That's a no-brainer. Of course, you should maximize those employer plans while you're eligible. But please do not stop there. The real acceleration into this better retirement that you can build, it comes from many things. Managing your tax picture. Using Roth accounts and brokerage accounts is what I mean there. Create that tax diversified mix from your taxable, tax-free, and pre-tax accounts. It allows you flexibility in retirement. Keep your modified adjusted gross income low. Try to eliminate debt, especially if it's a high interest rate debt. Plan your Social Security strategy with intent. Take it with a purpose. Build those cash reserves 12 to 18 months worth to handle the unexpected. These are the cornerstones of our Red Zone retirement planning process. This strategy is built to help you catch up by design, not just effort, because your retirement is about income, not about assets. That's what we solve for in our Red Zone retirement planning process. So now that you've seen why feeling financially behind at 55 plus, it's not a numbers problem, but a sequence awareness problem, and how MAGI, keeping it low, helps you out. How you can do strategic spend downs, how to time your Social Security strategically. And don't forget that having that Roth redirection strategy is going to give you leverage that high balance retirees often lose. You can now stop trying to catch up by saving more and start catching up by controlling how your money enters the tax system and, more importantly, how you take your money out of the tax system. So if you want help to build your dream retirement plan, click the link in the description below and I'll personally send you a video showing you how you can use our Red Zone retirement planning process before you're in the system and it stops giving you these options. Click the link in the description below the video and I'll see you on the next one.